Hello there. Welcome to week 3. The focus for this week will be non-current assets. Specifically, we'll look at IAS 16, property, plant and equipment, IAS 23, borrowing costs, IAS 20, government grant, and IAS 40, investment properties. There will be 2 videos for you this week. The first of which will focus on property, plant and equipment, and the second video will focus on the other 3 items. The learning outcomes are as follows. Property, plant and equipment, IAS 16, we will look at the definition of property, plant and equipment, recognition, the initial measurement, subsequent recognition or subsequent measurement, depreciation, and disclosure requirements. In the second video, we'll look at borrowing costs IAS 23, government grants IAS 20, and investment properties IAS 40. First, let's define property, plant, and equipment under IAS 16. IAS 16 defines property, plant, and equipment as tangible items that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. Now, the key features of these definitions, the key words are use. So in other words, if the property is held for resale, it cannot be part of property, plant, and equipment. It has to be held for use, for production or supply of goods or services, or held for rentals to others, or perhaps used for administrative purposes. And notice, the property, plant, and equipment are expected to be used during more than one period. If it is less than one period, then it cannot be an asset. It should be expensed or written off to the profit and loss account. This definition, therefore, covers the majority of tangible non-current assets that might normally be held by a business entity. Now that we have covered the definition of property, plant, and equipment, let us look at the recognition of them. Property, plant, and equipment should be recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the entity concerned, and the cost of the item can be measured reliably. The key word here is probable. An item is probable if it is more likely than not that future economic benefit associated with that item will arise. In percentage terms, it is more than 50%. Routine servicing, repair, and maintenance costs are not capital expenditure. So, for example, the cost of repair, renewal should be expensed and not added to the cost of the asset. But the cost of major replacements should be treated as capital expenditure and recognized as an addition to the carrying amount of the asset concerned. Recognition of property, plant, and equipment. There are 3 phases of recognition. The first is initial recognition. The second is subsequent recognition and derecognition. Initial recognition is the time that the item is first introduced into the financial statements. Subsequent recognition is what happened to the value of the item in subsequent periods each year, whether the item changes in value or not. And derecognition occurs when the item is either sold or destroyed and had to be removed from the financial statements. Let us first focus on initial recognition. On initial recognition, property, plant, and equipment should be measured at cost. And cost includes the purchase price including import duties and non-refundable purchase taxes, less trade discounts. An example of non-refundable purchase taxes would be VAT. If the entity is unable to reclaim the VAT paid on the purchase of the item, that cost will be added to the cost of the item. This might occur where the entity is not registered for VAT. We need to differentiate between trade discounts and settlement discounts. Trade discount is the discount that is given before the purchase of the item, perhaps to encourage those who belong to certain trades or to encourage bulk purchases. Settlement discount is given after purchase, where the seller wants to encourage the purchaser to pay earlier than the terms given. In this instance, we only deduct trade discounts. We do not deduct settlement discounts. The second component of cost are directly attributable costs. These are costs which are directly attributable to bringing the item to the location and condition necessary for it to be operated as intended. We will look at this shortly. The third item is the estimated cost of dismantling and removing the item and restoring the site on which the item is located. If the obligation to meet this cost is incurred when the item is acquired, this is normally referred to as decommissioning cost, where the entity is required to remove the asset at the end of its life. The cost of such removal, discounted to present value, will be added to the cost of the asset. So as you can see, there are three components of the costs. First is the purchase price, including, of course, import duties, including non-refundable purchase taxes and less trade discount. The second is directly attributable costs. And thirdly, decommissioning costs. Let's now explore directly attributable costs further. Directly attributable costs might include professional fees. So, for example, if the asset purchased is property, you may incur solicitor's fees. This will be added to the cost of the asset. Delivery costs, site preparation costs, assembly and testing costs. Costs that should be capitalized and included in the cost of a non-current asset are referred to as capital items. On the other hand, costs that should not be capitalized are referred to as revenue items. Such costs are expensed, in other words, written off to profit and loss. For the purpose of clarity, let me now expand more on costs by explaining items which should be included as part of the non-current asset and those which should not be included as part of non-current asset. The items that should be included as part of non-current assets are transaction costs on purchase, e.g. legal fees as mentioned earlier. Borrowing costs incurred if this is the policy under IAS 23, and this will be discussed in the second video. Invoice delivery costs, import duties, irrecoverable purchase taxes such as VAT that the entity cannot recover. The net present value of unavoidable future decommissioning costs under IAS 37. Installation and assembly costs, including site preparation costs. The cost on the right-hand side cannot be included as part of the cost of non-current asset, which means such costs will be written off to profit and loss account. Training costs, that will be costs incurred in training the employee, for example, in the use of the asset. Such a cost cannot be included as part of the cost of the asset. It must be written off to profit and loss account, in other words, expensed. Initial inefficiencies and losses during run-in. Administration or general overhead costs. Costs giving benefit for 1 year only or less than 1 year. Any cost due to abnormal losses in purchase, delivery or production, as they will not enhance earning capacity. And finally, any cost that will maintain current earning capacity of the asset rather than improve its intrinsic characteristics. For example, maintenance costs or cost of renewal. Here is an example. An entity H has incurred the following costs prior to bringing a machine into production. Purchase price before trade rebate and tax is $12,200. Trade rebate $600. Refundable purchase taxes $1,200. Architect's fees $700. Installation costs $100. Operating losses prior to achieving planned performance $250. Required. Calculate the amount at which the machine should be stated in the accounting records of entity H in accordance with IAS 16. Now, the purchase price before trade discount is indeed added as part of the cost, less trade discount. This is not settlement discount, so we can deduct it. The purchase tax is refundable. Because it's refundable, it cannot be added to the cost. Architect's fee is added, that's a directly attributable cost. Installation cost is added, but operating losses is not added. The answer is as follows. As you can see, the purchase price less trade rebate is $11,600, plus the architect's fee and the installation cost. So the total cost recognized for this machinery is $12,400, and this is the non-current asset shown in the financial statements. The rest of the costs will be expensed to profit and loss account. For a self-constructed assets, non-current assets that are constructed by the entity itself, any internal profits laden or abnormal costs should be excluded from the cost of that asset. Administrative expenses and other similar overheads should also be excluded from cost. Interest costs incurred in the course of construction may be included in accordance with IAS 23, borrowing costs, which we will discuss further in the next video. Subsequent measurement of property, plant, and equipment. After the initial recognition, property, plant, and equipment is measured under IAS 16 using either the cost model or the revaluation model. The cost model is where we leave the cost that was originally recognized, and each subsequent year, the item is now carried at cost less any accumulated depreciation and less accumulated impairment losses. In terms of the revaluation model, the items will be carried at fair value at the date of revaluation, less any subsequent accumulated depreciation and less any subsequent accumulated impairment losses. When an asset is revalued, the revalued amount basically replaces the cost, and depreciation then starts from the date of revaluation. Hence, less subsequent accumulated depreciation, which is the accumulated depreciation from the date of revaluation, or accumulated impairment losses from the date of revaluation. We will look at depreciation shortly in this video. As for impairment losses under IAS 36, that will be considered separately. If the revaluation model is used, then it must be applied to the entire classes of property, plant, and equipment. For example, if the entity decides to value one property, then all of the properties must be valued. The entity does not have to value other machinery, so to speak, so long as the assets of the same class are valued. When the revaluation model is used and the asset is restated to a new value, the value may go up or down. If there is an upward revaluation, in other words, the value has gone up, we have a revaluation gain. How do we account for such revaluation gain? It depends on whether the property is revalued for the first time. If the property is valued for the first time, then the gain is included in other comprehensive income and shown separately in the statement of changes in equity. So you have a separate component called revaluation reserve in the statement of changes in equity. That gain is not shown in profit and loss for that period. There is an exception to this. If the gain reverses previous revaluation loss, in other words, if the asset had previously been revalued and there was a loss, that loss having gone through profit and loss account, and this gain reverses that loss, then to the extent of that reversal, the gain will go to profit and loss. Any excess is taken to other comprehensive income. We will explain this principle further by way of example during the live session. It is possible that when the asset is revalued, it is revalued downward. So a downward revaluation is a loss. And that loss, if it is the first time, is recognized in profit or loss, not in other comprehensive income. Again, there is an exception which is the complete opposite of the one we looked at before. In other words, if this asset had previously been revalued at a gain, and the gain had gone to other comprehensive income, now that you revalue it at a loss, part of that loss will go to other comprehensive income to offset the balance of that gain. Only the excess loss will go to profit and loss account. Again, this will be explained more by way of example during the live sessions. Depreciation of property, plant, and equipment. IAS 16 defines depreciation as the systematic allocation of the depreciable amount of an asset over its useful life. Now, first of all, let us clear the misconception that depreciation is a loss of value. Depreciation is not a loss of value as we know it in normal terms. Because the asset is in use, the cost of the asset used is expensed. The process of expensing the cost of asset used is known as depreciation. Basically, the cost is allocated over the period that we expect to use the asset. So the process of that cost allocation is what we refer to as depreciation. Now, it says the systematic allocation of depreciable amount. What is a depreciable amount? This is the cost of an asset or other amount substituted for cost less its residual value. So, if the cost of an asset is £10,000 and you are going to sell it in the future for £2,000, the net cost to the entity is £8,000. That is the depreciable amount, and that is the cost that must be allocated over the useful life of the asset. So the residual value, therefore, is the estimated amount that an entity would obtain from disposal of that asset after deducting any estimated costs of disposal. The useful life of the asset is a period over which an entity or over which an asset is expected to be available for use by an entity. So in other words, the useful life is a period over which the entity will use the asset. To clarify what I've explained earlier, what is the purpose of depreciation? The purpose of depreciation is to allocate an expense between accounting periods. Basically, it's an allocation of that cost over the period of use of the asset. In particular, depreciation does not mean that the assets are shown at their current values. It does not mean that the value of the asset has fallen and therefore we must show it at that value. That is not depreciation. Also, we must bear in mind that the depreciation does not guarantee that there will be funds available to replace assets when they come to the end of their useful life. It is simply the process of allocating the cost over the period expected by the entity to use the asset. Because residual values and useful economic lives are estimates, because when you buy the asset, you depreciate it over the useful economic life. Now, the useful economic life or the useful life of the asset is ascertained at the time of acquisition. The residual value is also ascertained at the time of acquisition. We are not certain, there is no certainty as to how long the asset will actually last or what the value will be 10 years hence. For this reason, the residual value and the useful life of property, plant, and equipment should be reviewed by the entity at least at end of each financial year. If during that review it transpires that the useful economic life or the residual value differs from the previous assessment, then any such change or differences will be accounted for as a change in accounting estimate, as we discussed in week 2 under IAS 8. So that change will not be accounted for retrospectively, but will be accounted for prospectively from the date of the change. Depreciable amount revised to reflect any change in residual value, and then this amount is allocated as depreciation over the remainder of the asset's expected useful life. What are the methods of depreciation? There are a few methods that can be used to depreciate an asset. Most of the commonly used methods are straight line method. This is where you expect that the asset will be used on an equal basis over the useful life. Reducing or diminishing balance method, or the units of production method. Now, any of these methods could be chosen. However, the method chosen by an entity should reflect, or should most closely reflect, the pattern of usage of the asset and be applied consistently. So if, for example, when the asset is used or new, we will use most of the asset when new as opposed to when it is old, then the reducing balance method will become appropriate. If, on the other hand, the asset will be used on an equal basis over the useful economic life, then the straight line method will be appropriate. If it's a machine that is based on the number of units produced by the machine, then the units of production method becomes appropriate. Finally, let's consider examples of depreciation. Entity K owns a machine which it purchased for $4,400 on 1 January year 1. The machine was estimated to have a residual value of $1,400. So that means the depreciable amount is $3,000, which is $4,400 minus $1,400. Required: calculate the depreciation charge for year 1 and year 2 using the straight line method, assuming that the machine has a useful life of 4 years. So in that case, we take the 3,000 and divide by 4, which is $750 each year. B, the reducing balance method, using a rate of 25%. C, the units of production method, on the basis that the machine has a capacity over its life of 100,000 units. So over the life, it has a capacity of 100,000. And in year 1, has produced 28,000 units. And in year 2, has produced 26,000 units. Show the carrying amount of the asset at end of year 1 and at end of year 2. So here is the answer. As I said earlier, on the straight line method, first we work out the depreciable amount, which is $3,000. Straight line depreciation means we'll take the $3,000 divided by 4 years, which is $750 per year. For units of production method, 3,000 is the depreciable amount divided by 10,000 units, which means for every unit is 3 cents per unit produced. So based on that, the straight line method is $750. The reducing balance method is 4,000, not the depreciable amount, the cost, 4,400 times 25, which is 1,100. So if you deduct 1,100 from 4,400, you are left with a balance of 3,300, and 25% will be applied to this in year 2. As far as the units of production method is concerned, we've produced 28,000 units at 3 cents, which is $840. In year 2, again the straight line method is the same, $750 each year. As for the reducing balance method, remember we had 3,300 left, so we multiply that by 25%, which is $825. So each year the depreciation amount reduces. So 3,300 minus 825 now leaves a year-end balance of 2,475. As for the units of production method, it's 26,000 times 3 cents, which is $780. Based on that, we can make a comparison of the methods, straight line, reducing balance, and the unit of production method. So the cost remains at 4,400. For the first year, the straight line was $750, and the reducing balance was 1,100. Units of production was 840, leaving a carrying amount or net book value at the end of year 1 of 3,650 under the straight line method, 3,300 under the reducing balance method, and 3,560 under the units of production method. As you can see, because these are accounting estimates, we end up with different figures. In year 2, the depreciation is the same under the straight line method, say $750, so we are left with net book value of $2,900. For reducing balance method, that was $825, and so we are left with $2,475, as we said earlier. And as far as the units of production method is concerned, we deduct the $780 from that, so we are left with $2,780. As you can see, depending on the method that we use, we will have different results. Review of depreciation methods. Depreciation method is reviewed at least at the end of each financial year. If the pattern of usage or usage pattern changes, the method must change to reflect the new usage pattern. A change in depreciation method is accounted for as a change in accounting estimate in accordance with the requirements of IAS 8 and therefore accounted for prospectively. Finally, meet disclosure requirements of IAS 16. For each class of property, plant, and equipment, the entity must disclose the measurement basis used, the depreciation methods used. It must also disclose the gross carrying amount and accumulated depreciation at the beginning and at the end of the accounting period. There must be a reconciliation of the carrying amount at the beginning and at the end of the period. This reconciliation must show any addition, disposals, revaluation increases or decreases, depreciation, impairment losses, and any other movements. This concludes the first part of the video for this week. The second part will look at IAS 23 borrowing costs, which are directly attributable costs, together with IAS 20 in government grants and IAS 40 investment properties. I strongly recommend that you review the question in our lab page and submit your answer via the our feed. Thank you for listening. See you in the next video.